Hey everybody, welcome to the morning market briefing. It is Friday, March 25th, 2022. Hope everybody's hanging in there. Hope the week has been good. Hope you're ready for a good weekend. Nice spring day out there. So hope your allergies are in check. Lots of good wishes for you guys this morning. Lots to talk about. We're going to kind of spend some of this call just reframing to an extent where we are on the market and where things are positioned. But we're going to open up first talking about the United States and the European Union announcing agreement on liquid natural gas. Then talk this through because it's a relatively complicated issue, and I think there's some nuance and context that needs to be provided above just what the headlines are.
Yeah, we talked a little bit about this yesterday on the call, and we understand liquefaction terminals. You need liquefaction capacity, and that's going to have to be in the United States. And then you need regasification capacity in Europe. You also need pipelines from that regasification capacity in Europe. So there's going to have to be a lot of construction done in order to rejigger all of this. And this takes time. I mean, I told this story yesterday, but when you're trying to permit a liquefied natural gas plant in the United States, it is exceptionally difficult. I mean, you're talking about cooling natural gas to negative 150, negative 200 degrees, and then keeping it cold while you ship it across the ocean. And to do this, a lot of U.S. companies who finally were able to get permits, permitting was a nightmare for this. I was working in Oregon at the time, and there was a project in Coos Bay called Jordan Cove. And this was a 10-year projecting deal. And you had to get FERC approval, you had to get approval from the DOE, and then you also had to get approval from the EPA. And then you needed the pipelines, and you needed the liquefaction terminal. And there was a huge environmental concern because of the pipelines that would go to the liquefaction terminal. So there are a lot of issues with respect to LNG and getting those terminals upgraded. And the fact that we haven't been aggressive in doing that over the last 10 years has really put us in this bind right now where we only have a limited amount of liquefaction capacity in the United States. That's number one. Number two is you don't have the gasification capacity in Europe. The third issue is the liquefaction capacity that we do have in the United States. A lot of times these companies, these sponsors who are actually building these terminals, they're extremely expensive to build, in the tens of billions of dollars to build trains that actually have, they call them trains, they call them terminals, to actually liquefy this gas. You need a lot of capital to do that. And so what a lot of these companies have done, they've partnered with utilities in Japan or in India, and those utilities have helped to fund, along with the public markets, the construction of these liquefaction terminals. And you have long-term contracts that have been signed in order to give investors certainty that there is going to be offtake capacity for this huge plant that you've just built, because you don't want to build a plant and then just say, if we build it, they will come. That's not how you do things. And so what the US has now done, the administration has gone into Europe and said, you know what, we're actually going to export a ton of liquefied natural gas to Europe. And I think that's the overall context. Europe right now takes in about 150 to 180 billion cubic meters of gas a year from Russia. So 150 to 180 from Russia, 400 billion cubic meters of imports annually. That's for Europe. So 40% of Europe's imports of natural gas come from Russia. That 150, 180 billion number. What we're trying to do, what Europe has promised to do, is that they're going to ensure demand for 50 billion cubic meters of US LNG until at least 2030. So for the next 10 years or thereabouts, Europe is going to try to go from essentially zero imports from the US to 50 billion cubic meters of imports. Again, that's only a third of Russia's total gas provided to Europe. So you're saying, well, what's going to happen to the other 100? They haven't really answered that question yet. They said that, well, some of that can be replaced with renewables. And we still haven't even answered the question, how are we actually going to get that LNG? Are we going to have to break the contracts with the Japanese and the Indian customers? There's a whole lot of questions that need to be answered. We're not even solving the whole problem with Russian gas. And so I think this is being paraded as a little bit of a, as not a little bit, but as a huge way for Europe to wean itself off Russian gas. But my opinion is this is going to be very difficult to do. It's going to be exceptionally difficult to sustain over the long term. And I don't think it's really actionable in the near term. I think this could help at the margin, but I think that ultimately that's where it helps. And if Europe is serious about this, if the US is serious about this, then there's going to have to be a ton more investment in both regions in order to actually fulfill these mandates.
Good stuff, Ben. That's like a really good way to contextualize this. I mean, I ran by the house to take Hayden to school, and they're talking about it on whatever morning show my wife watches, all these things. And I think sometimes you can kind of get overwhelmed by the numbers, and without the context, it's hard to really tell what the actual policy is. This is another one. There's a lot of details missing. It's kind of like when we're releasing oil reserves. Once you have the context, it's potentially less meaningful than you think. It's going to be a long story, especially on this side in terms of how it plays out. Certainly something to monitor. Again, I don't think it's bad, but it's hard really to quantify what kind of impact it's going to have. And so I would just kind of caution everybody as it relates to that. If your interpretation is that this is drastically overnight reducing European energy dependence on Russia, I just don't think it's that, to a significant extent. Switching gears, we've got the Bank of America bull bear indicator, fell to 2, which we talked about a little bit. I think last week we even talked about how that's a traditional buy signal. We were slowly inching our way to there. Ben, what are we seeing, just on that survey results? And I want to throw it to Tom, and then we'll kind of wrap up today by kind of taking a step back and seeing why there could be optimism for the market.
Yeah, it was interesting. It fell to 2 despite the fact that the market rallied over the last week. So the reason that happened was because as the market did rally, a lot of long only funds used that as an opportunity to sell the rally. So they basically shifted from a mentality of buying the dip to selling the rip. And that's what we saw. So long only positioning fell to just the 19th percentile of traditional exposure. Long only is what we do. It means you're not shorting the market, unlike a hedge fund. And yeah, just 19th percentile throughout the time that B of A has tracked this data. So that is a buy signal to their mind. B of A actually is fairly negative on the markets, and so is caught a little bit between two narratives right now, saying we don't really like where things are going, we don't really like the rate hikes, but at the same time, sentiment is really bad. And so they're kind of trying to sort that out for themselves internally. What we see is that sentiment's very weak.
Good deal. Thanks, Ben. Tom, wrapping up the week kind of in bond world. Obviously, it's been just a chaotic start to the year, but what are you seeing? Anything you're keeping an eye on in terms of actionable ideas?
Yeah, I mean, it's going to be another down day. And I think something to keep in mind, too, is I actually got a text from a call participant right after the call yesterday asking if it's not actually a good thing that rates are going up. And I think that particularly for those in retirement or those approaching retirement, this is actually a great scenario. If you think of the traditional 60-40 portfolio, if 40% of your portfolio is only yielding 1%, and you've got to have a duration of, call it 7 or 8 to achieve that, you're really not taking that 40% that is supposed to be the safety portion of the portfolio and having a lot of safety there. You've got a lot of downside risk with rates going up, with credit quality in order to achieve that. And so I think that one thing that is a real positive from the bond market selling off is, we've constantly got money come back due. So every time we can buy a bond now that will reduce the risk in your portfolio as well as enhance the yield. And that's not the same scenario as we have in a falling interest rate environment. So, we basically get better returns, better risk profiles on every single bond now than we could a year ago, 2 years ago. And we can do it all over the curve because it's very flat. So even though, we're seeing the existing bonds and portfolios priced down, we know we're going to get them back at par. We know we're going to make money provided they don't default, which is why we do so much work on the credit side. So there's really not that much to worry about. That principal loss is going to happen no matter what. It just happens faster because rates have risen. We're going to go back to par no matter what. So it's kind of tough to wrap your mind around that kind of bond math. I know a lot of people don't delve into it that deeply, but something to remember is that rising rates benefits retired people, it benefits savers. So you get more bang for your buck in the lower risk area of the portfolio.
Good deal. Thanks, Tom. Ben, we kind of teed this up a little bit. You talked about Bank of America and their inner conflicts. They're wrestling their demons of saying, hey, we have this big survey and this indicator that we say suggests we should be bullish, and yet we are not. Taking a step back, what's really kind of your case for a bullish view on the market? And then we'll get the bearish side.
On the bullish side, I think that there are a couple things. First is you could be setting up for a fairly attractive scenario in Q2. What's an attractive scenario? An attractive scenario is when you have decelerating inflation and accelerating growth. Why would you have decelerating inflation? Well, number one, we got data out of the market PMI yesterday that said prices were starting to cool off just a little bit. Again, just at the margin. You see lower used car prices. Used car prices fell by the most for a number of months on a month-over-month basis, and are falling and are decelerating on a year-over-year basis. So that'll help on the inflation side. And you could see slowing home price growth due to higher mortgage rates. I know we talked yesterday about Lennar seeing higher home prices, but that's potentially backward looking because those are contracts that are already signed. My view is that you might see just a little bit at the margin, the home price growth taper off a little bit. And by that, I mean, we're not going to go up 15%. We may go up 8% this year in terms of home prices. Why might you have accelerating and also on the deflation side, this decelerating inflation, you also have oil prices that have actually been fairly stagnant. Once they ripped up to $100 a barrel, they've been fairly stagnant. And if you look out on the curve, futures are implying that oil prices are actually going to be falling over the next number of months. Why might you have accelerating growth? Well, number one is that we had really pretty dismal growth here in Q1. Growth is probably going to come in at about 1% to 2%, depending on if you look at the analysts or if you look at the Atlanta Fed, which has about 1.5%. You have an improving supply chain. We are starting to see noise that the supply chains are improving, whether you're looking at the autos, whether you're looking at that market PMI that we talked about. That we got information from yesterday. Supply chain is beginning to ease. KB Home talked about it as well. They were having to buy ovens from retail in Q1, and they're starting to see some of that ease up a little bit. You're going to have really strong net exports. Net exports are a factor in GDP growth. You look at consumption, you look at investment, you look at government spending, and you look at net exports. And especially if we're going to be exporting more energy at higher prices, that's good for overall growth in the U.S. economy. And then finally, you will have improving productivity. There were people working in January who weren't coming into the office or going into the retail establishment because they had Omicron. And that really hit things in the first few weeks of January. And we're not going to have that as much, hopefully, in Q2, although we do have to continue to watch out for that BA2 variant. So on that front, you have decelerating inflation, you have accelerating growth potentially in Q2, and that's what they call the Goldilocks scenario. And that's really a good thing for risk assets. And I think that would be good. And if you look at what companies are seeing, I know there's been a whole narrative on inflation just eviscerating companies, Russia, Ukraine, creating so much uncertainty that companies don't know anything they're doing. We put out a survey that we give every quarter to business owners who are clients of ours, and we're starting to get some filter through. And some of them aren't even filling out the survey because they said just copy what I had last time, because it's nothing really has changed over the last 3 months. Earnings reports are saying the same things. Even if you look at Adobe, which actually disappointed on earnings, they kept the whole full year guidance. KB Home actually raised guidance for the year. So we're seeing companies actually come in relatively as predicted. In fact, if anything, we're actually seeing, I wanted to share a portion of the screen, but I'm not sure if this will work. Here we go. if you can see this, you have the annual earnings per share squiggles. So this is basically how have earnings estimates changed over the first quarter? And if you look at this top left, earnings estimates have actually gone up so far in Q1. And so when people are talking about earnings estimates coming down and the Russia-Ukraine stuff and the inflation things really taking down earnings estimates, that's just a false narrative. So you're actually getting, especially with the market decline, you're getting the same companies at a cheaper price, and they see basically the same thing that they saw at the beginning of the year. So that's the bullish case.
Yeah, and I think kind of bridging to the bearish case. I mean, it's been an interesting dynamic. I was chatting with somebody in the backyard the other day, one of our neighbors, and he was like, "Man, I bet it's just been wild this month for you. You know, the market's so crazy, this, that, and the other." And at a certain level, it is. But right now, Ben, if we look back over the last month, the S&P 500 is up 3.09%. We're entering month 2 of this conflict. There's still uncertainty, but the market's actually responded relatively well. I mean, that's a 44% annualized rate of return. If we got 3% every month, I think people would be very excited. And so we've seen some resilience. And, you know, when we think about the bearish case, I think you're thinking about inflation. You're thinking about rate hikes. I think you're thinking about potential shifts with how consumers are behaving. But the number one thing people are talking to us about, at least right now, continues to be kind of the unknown of Russia and Ukraine. And I understand that concern, but to an extent, since that conflict really came to a head and the invasion started, the market's up. And so I think the general narrative in a lot of ways is relatively false. I think there's reason to be concerned about it. I'm not saying there's not, but the market has not been. At least not to a great extent. Ben, what's kind of the bearish concern? You know, how would you kind of quantify those? If you were ranking, you know, the factors, what's legitimate versus just, you know, political fodder?
Yeah, I think you have four things. You have the known unknown of Russia, Ukraine. You have inflation. You have Fed rate increases, and then you have a potential shift in consumer spending from goods to services. At Norwell, there are narratives and there are numbers. And I think when the two are in conflict, we tend to follow the numbers. And that's why we would lean a little bit more to the bullish camp here, because the numbers are saying what the numbers say. The narratives are the bearish case. And the narratives I would rank as the follows. I think that inflation is probably the number one. I have Fed rate increases as the number 2 bearish case. Number 3, I'd have the Russia-Ukraine. And then number 4, I'd have the shift in spending from goods to services. The reason I'd have inflation over Fed rate increases is because the Fed rate increases are going to be a function of inflation. So that's where those two come into effect. And then the reason I have those over the Russia-Ukraine situation is because we have ample evidence that Fed overstepping on rate increases coincides with a recession. We don't have as good evidence that war correlates with recession. As crazy as that sounds, that's the case. I mean, the Iraq war, you know, didn't correlate with recession. You look at some of these other wars, doesn't necessarily correlate with a recession. You do have Fed rate increases being overly aggressive can correlate with a recession. It's happened on multiple occasions. So that's where I would see the balance of risks.
Awesome. Thanks, Ben. Tom, I want to throw to you last. Just, you know, Ben and I both kind of weighed in on both sides. You know, when you're kind of thinking of positioning, I mean, I'll almost frame it the way we get asked a lot, you know, is this a good time to be putting money to work? You know, at a high level, we're not trying to time the market, but just would you lean towards yes or no?
My go-to answer is it depends if you need the money in the next 2 years. You know, if you got a long-term outlook, I think this is an opportunistic time, particularly for bonds. I mean, bonds are worse off right now than they have been really as long as I can remember, with the exception of the great meltdown of March 2020. You know, if you need money in the next 2 years, you know, there's going to be a lot of volatility. I think there's no bones about it. We're going to see a bouncing market, so you may not get your money back, right away in the amount that you put it in. But I think that if you're thinking, 3, 4, 5 years from now, there's going to be winners and losers either from the either Ukraine conflict, from the rate hikes, from oil prices bouncing all over the place, potentially from building new, regasification terminals in Europe. There's going to be winners and losers all over the place. The question is, do you have the time to invest in those things and see them come to fruition? It's essentially like, do you want green bananas or yellow bananas? Because if you buy the green bananas, you're going to have to wait a while. If you're looking for yellow bananas, maybe now is not the time. And so that's how I would approach it. But I think there's always opportunities, whether it be in the equity side or the bond side. So the question really is, do you have the time to see those come to fruition? Would be my answer.
All right, Banana Tom, we'll wrap it up there. Hope you guys have a great weekend. We will be back Monday, 8:30, and we'll talk to you guys then.